What's going on, Bat fam? Welcome back to the Build a Trader YouTube channel. In this video, I'll be making a new time frame correlation video. Last one had a bunch of clicking sounds. This one is going to be more direct, precise, and we're just going to dive right into things. Okay, so before we begin here, I'm going to draw up our examples with the arrows here of the 4 situations that you need to be aware of. Now remember, we have our classic uptrend bullish situation, higher highs, higher lows, right? Yes. Next we have our downtrend situation, lower highs and lower lows. Okay. And I'll throw some labels on there shortly after I draw them up. Next we have our transition from bullish to bearish market structure, which is like this, higher highs and higher lows, until it makes a lower high and then a lower low point, right? And same with our bearish to bullish structure, change in structure, so it goes from lower highs, lower lows, and makes a higher low point, and higher high, higher low, higher high, right? Transitioning from bearish to bullish. So I'm going to throw these labels on here if you don't already know what they are. And if you're unfamiliar with this concept, watch my earlier videos on market structure and support resistance, as this will tie hand in hand directly with this concept. Now go ahead and take a screenshot of these notes. I'm about to go over 4 different examples of this exact concept and also show you how to potentially find an entry point and place your stop loss in these certain exact situations that I'm about to show you. So let's dive right in here. Example 1. Now remember, this is time frame correlation. So we're not only going to be on one time frame, we're going to be on multiple time frames, hence time frame correlation. So I'm going to go to, let's split the screen here. That way we can see some more details. So on the left side of the screen, I'm going to change this time frame to the 4-hour time frame. Okay? And that's how we're just going to start things off right now. So the very first example I'm going to show you is just an uptrend, right? Remember, higher highs and higher lows. I'm going to draw this arrow real quick. This is the first situation I'm going to show. Now this situation right here that I just quickly drew with the arrows is this whole area right here. Now I'm going to go over exactly how this looks on both time frames and how one could take advantage of this move throughout the week or last couple weeks, as this is a UJ has been pretty bullish. So let's go over this here. Now on the left side, I'm going to drop down to a lower time frame, the 2-hour. And on the right side, I'm going to zoom in some so that you guys can see a little more details. So what do we see here? Well, you can see on the right side, there's nothing but solid bullish candles. And on the left side, there's bullish candles with bearish candles as well. So let me illustrate this. Push, pull back, push, pull back, push, retracement, push, higher low to another higher high, retracement, higher high, slight pullback / consolidation, and then another higher high point. So I'm going to stop drawing these arrows right here. Now you can see on this left side where I have all these arrows, right? You can see what higher highs and higher low points very clearly. Higher low. Okay. Higher low, which this could look like it was broken, but it was not. This is a lower time frame structure. For it actually to break and switch directions from bearish to bullish or bullish to bearish, it depends on what time frame you're looking at. If it breaks structure on the higher time frame, then it's 100% going to change the direction that's going in from bearish to bullish and vice versa. But if it happens on a lower time frame, that is a lower time frame move. So it's typically a correction or a pullback / retracement. So it might not actually be valid or in line with the overall higher time frame trend, which is very important as to knowing market structure and time frame correlation. So higher low, and then another higher low. You can see that in that classic example I showed, the textbook example, it was like this. It's higher highs and higher lows, right? You can't see that because it's just full bullish candles right here on the right. But on the left, you can see this clear as day because there's more details, right? Yes, you can clearly see it's higher highs and higher lows. I'm only going to add a few more arcs on here, as you can kind of already see the whole point I'm trying to illustrate. As you know, price action is very, very clear. And these are the type of setups you're looking for, the market behavior you're looking for, because this is when it's the cleanest and you can see it clearly. When you can't see it clearly and it's not clean, you can't trade. It's that simple. It's literally that simple. Okay, and I'm gonna add one more on this one. So now you may be wondering, okay, great, you just broke down this uptrend and how it looks for us. But how do we take advantage of this? Now this is where things get interesting. If you watched my intro to key levels and candlestick pattern video, this is how you find the trades. Let's break things down. So you can see there's not a lot of detail in this daily time frame here, and you don't know exactly what will happen next. But after this point right here that broke, I'm gonna back up. This is what initiated the large uptrend move, large breakout, because this was one, a breakout pattern, a double bottom, serious support, and also it broke higher time frame structure. Remember that exact concept I was just talking about a minute ago? Well, this is structure on the higher time frame, right? So it broke its previous high and initiated a breakout point. It broke structure, or in this case continued in line with the overall trend, the bearish trend. But what needed to happen for this breakout to happen was a break of this blue line down here where the yellow circle is. So once this happened, initiated a breakout point. So if you miss this area, the entry point, that's fine, because you don't always have to buy the lowest point in an uptrend. You don't have to buy the lowest low. The whole point is to buy low enough and be able to manage your risk effectively and still be able to profit, hence risk to reward, right? So let's break things down a little bit more. So let's start here. You missed this whole first push, right? I have this red arrow. You're going, crap, how do I get in? This whole first push is just this right here. Just these candles. So we're going to pretend this whole area right here is not necessarily here quite yet. I could go through the replay mode and just remove them, but I don't want to have to do that right now. So add a couple more things. We have key level right here. Remember, this is the pullback and the higher low point that was created. And if this broke, then the market might have corrected even lower, but it didn't. It needed to hold this in order to continue its uptrend, right? So you see this isn't necessarily here yet. You see this right here, that's it. This is it. So yeah, a low point, a higher high point, a higher low point. You see this on the daily time frame right here. Nothing but bullish, right? So you could assume a retest, but in situations like this, especially when the market's strong trending like this, when these super strong bullish candles, no wicks on them whatsoever, just basically full body closures, you need to expect a continuation. You shouldn't expect a reversal. You should almost always expect continuations in the market unless there's a higher time frame break of structure. So you see this, what do? Potentially, you'd see this, you'd see the wick, you could enter on this candle here. Now I'm gonna go to a lower time frame to illustrate this, but this is just a quick example. And then your stop loss would be below this low point, how it is down here, where I have it. Because if it breaks the low, it's going to go lower, right? That's why you have a stop loss there to manage your risk if things get invalidated. So you have it below the low point. If you get stopped out, then you know that's what happens sometimes. But if you were to enter, right, you have this level already marked up, okay, because you're anticipating the market to make a higher low somewhere for you to get in to catch this overall bullish move. So see that hit there, okay. You see that something's going on right here on the 1 hour time frame. So you can go lower, the 30-minute, and this is how you refine your entry points and understand what's going on, right? So you see, okay, a higher low, another higher low point, all right. So this is your first clue that the market's going to continue in the overall direction. And then what happened? There's a strong bullish candle right here. This one right here that completely outdid everything else, right? That's your first that's your indication, as well as these wick candles right here. These candles that created some wicks and closed bullish. Those are your two signs how you could have understood that, all right, you can take the risk here. The market is showing an opportunity, and this is what it would look like. And you enter. You know, it doesn't have to be at the very bottom. You don't have to catch the wick. You know, that's very hard to do. A lot of times you might have a little drawdown. So say you enter right here on this bearish candle, because you saw this, and you're like, okay, yeah, it's just going to continue. Boom, a little drawdown to kind of freak you out, but that's okay. Drawdown is okay. You need to embrace the drawdown. Most of your trades will have drawdown. Just you need to have a reasonable amount, right? Because it's about risk management. And then you have your stop loss down here, and then you just let the probabilities play out. And you would make a take profit level based off of resistance. So you could have did it right here, you know, based off where it hit last time. But if you're anticipating a higher high point, you know, in an uptrend, it makes higher highs and higher lows. So you see a higher low, you're expecting a higher high point. So you're going to use the higher time frame to anticipate a potential higher time frame level that the market will hit in line with the higher time frame trend, right? So right here's where we entered. This would be like the 4 hour time frame. On a more intraday time frame, you can see there is strong bullish momentum, pushed up, it broke this resistance, and there is actually a higher time frame level that you could find if you really wanted to, right here. So right around this area you could expect some type of reaction just based off of previous behavior, because the market hasn't been that high since December 2016. So one could expect, okay, you already have this level marked up. You could see this area as an important area of previous resistance, a higher time frame key level. And then you anticipate, okay, if this previous high breaks, then there's going to be momentum to push it up to this next level. And it's that simple. Okay, guys, next example. I'm going to be breaking down this area here in the gray zone. So in this example, I'm going to be showing you what a downtrend looks like, bearish market structure, lower highs and lower lows. And I'm also going to show you what a transition from bearish market structure, a downtrend, to bullish market structure, right? This would be our next scenario we're looking at. So I'm going to go over this scenario and the scenario, and also show you potential ways that you could take trades based off the same exact concepts. So I'm going to remove these. And on the right side, we have the daily time frame. So you can see that it's bearish right here, right? And on the 4 hour time frame on the left, you see lower highs and lower lows. So I'm going to draw some arrows so you can see if you don't already see. Now I know a lot of this might be a lot to take in at first, but these concepts are actually very simple, and you just need practice in chart time, and you need to do this on your own charts, because once you practice and mark your own charts up like this, then these concepts they make more sense. They start to click. All right, and that's all I'm going to do on this side. So you can see what lower highs and lower lows the entire time. I'm only going to add a few arcs just to illustrate, but lower high, low, and another lower high, and another lower low point down here. As you can see, it's very clear. Now, how does one take a trade setup based off of knowing this information? Well, here is how you do it. So you understand that looking on this left side, the market was really bullish, right? It had to break this previous high and made a new higher high, which is this right here at the top of the zone. This would be the new higher high point on the higher time frame. And you also have a level down here that you need to, that is very important, where the market previously broke out from, right? Because it went higher low, higher high, higher low, then broke all the way up. So this level is a very important level of structure as well as a key level. So this level is important, and after that, this level is important. Those are mainly the two things you have to look at when correlating time frames and looking for continuations and areas to get in, because some areas are stronger than others. And it's very important to identify the stronger levels over the not as strong levels, because the probabilities are going to play out more in your favor off of these stronger levels. So we can see that higher high. Okay, first lower high here on the lower time frame, on the 4 hour. That's your first clue that, okay, you know what? We're either consolidating, which means moving sideways, or we're going to start making lower highs and lower lows as such. So let's go down to lower time frame. See, it's bearish, then had its bullish retracement, made a lower high here, and made a low point, and this level needed a break again in order for it to be bearish, right? So what you're waiting for in this situation would be something like this. You see this candle pattern right here. This is a sell signal based off the wick and exhaustion, as well as this being a area of resistance now. Because if the market was going to continue, right, it has to make higher highs and higher lows. So this high would need to be broken, but it didn't break. As you can see, it keeps rejecting here and creating a resistance. So that's your first sign and how you can find a way to get in, right? And then you have, so you draw that resistance, then you, once you understand candle patterns, you understand this is a triple top or an inverse head and shoulder, depending how you want to look at it. And then once you identify that, you just accept the risk, apply the risk to reward tool, accept your risk, you can place your stop loss above this wick and have it pretty tight, or above the previous point of structure, which is also very safe, and there's nothing wrong with that. You're going to be targeting a new low point, which could be this level right here that the market previously had a break, which is very sensible and highly probable. I'm going to adjust this because it actually is slightly higher, right? So in anticipation of that, you'd be waiting to take profit down there. And if there's a retracement, that's fine. It depends on your trading style. You know, I might have closed knowing like, okay, it didn't quite hit, it's close enough, just take the profit. Other traders will let this play out. As you can see, the probability still played out. It made another lower high point and then continued down to the low and ended up breaking that level. Now I'm going to remove these arrows so you can see a little more details here. Yeah, much cleaner, much cleaner. I should do this a minute ago, my apologies. But now if you look at the right side at the daily time frame, what's going on here? There's making bearish candles in these top wicks. So if you can identify these top wicks here forming on the higher time frames, that's your indication that, okay, something's changing. So you jump down the lower time frame, how we just did. I'm gonna change this. So once you identify the behavior kind of changing and not necessarily behaving like an uptrend would, right? Because it's not an uptrend if it's behaving like that. My bad. Right, it's not an uptrend if the market's starting to behave in that type of way. Something else is happening. It's changing directions. It's changing momentum. You know, that's where you have to adapt and learn and be able to use time frame correlation and market structure and understand what's going on. So you can see these top wicks, a resistance was formed. There's another lower high. You know, one could have caught this move the day before, this first push, which was the move I just illustrated, and then understand, okay, there might be a pullback based off the higher time frame, which there was, which created this top wick. And then one could have also found entry points just based off of support and resistance and key levels, right? Because look, lower high, this is the resistance, and this is the level of support. Since this broke, the market is either going to test this level here, which is the previous high, the major key level of structure, or this previous point of support. Both of these entry points are very ideal. However, if they get violated, then that means the market's going back in the overall direction. And that's fine. This game is about probabilities and accepting your risk and letting these probabilities play out. So next example here. This is coming right off the same exact area. So you can see the market was bearish up until it hit this level, right? Which was that major level of structure I was talking about off the daily time frame. So as you can see, there's a major reaction after this first low point and first touch here. Created a high, a higher low, and a higher high. Then came all the way back down, making bearish structure. Up until it hit this point again and took off, right? This low point came up, higher low, higher high, higher low, higher high. Now if you notice the structure and these arrows, look at this. Bearish, bullish, higher low, higher high, higher low, higher high. Something had to change though to initiate this breakout move, and that was a break of structure, which is this blue level here. You can see this is the previous lower high point right down here. And once the market first poked up and broke it, that was your first clue of like, okay, the market is most likely going to transition. You can see it's made a first higher low, now it just made a higher high. If it makes another higher low, then you could possibly enter on this point right here, which is this blue arrow, blue arc. So you could be looking for entries in anticipation of this higher low point and using a higher time frame structure and looking at the higher time frame trend. You can see that this previous candle wasn't that strong of a bearish candle. And if you're looking at the lower candle or lower time frame, you can see that it's a higher low. So using both of these, just these two screens I'm showing right now, this is more than enough data than you need to possibly make a decision. And then you go down to the lower time frames to get more details and refine and see what's going on. So that's why we have this blue level here, because I know that this is a lower time frame key level and point of structure. If this breaks, it's going to make, and if this higher high breaks, it's going to initiate a breakout move, which it did. So how could one take advantage of this? So say you miss this higher low point, that's fine. It's hard to catch the higher low point sometimes, but you know that the market's about to make a higher high and push to a higher time frame level. So this is how you would take advantage of that. You can see this is the previous high. Let's say right here, you just saw this bullish candle here and you're like, how do I get in? I don't know how to take advantage of this. And that's completely normal, because one would assume that's too high to get in, but it's not if you understand certain behaviors in the market and certain things that need to happen. So let me add this risk reward tool. I drew this blue line right here, by the way, because this is a daily time frame point of structure, right? Because this is a lower high point. If this breaks, then a higher time frame level is going to be hit, which this is why it attempted this level here, because this point of structure broke, right? If structure breaks, that's the first concept I said earlier. If a higher time frame structure breaks, it leads to a larger move, okay? And if it's a lower time frame structure break, it's not quite as large of a move, but once it all lines up, then that creates the overall larger breakout move. So you can see here, that's what happened. There was a breakout move on the lower time frame, which caused this push, but the real big move happened based off the higher time frame. Well, one, once it first attempted this area right here, and then two, once it broke, that's why it filled with even more bullish momentum and volume, right? So back to this. So this would be the higher low point and also known as structure. So if this area were to break, your uptrend / buy scenario is no longer valid. But based off the given information, you have to accept the risk that this is buys. So this information, these candlesticks right here, aren't here yet, but based off of what you can currently see, it's clearly bullish, and you need to take the risk and according to that. So you have your stop loss below this point, below this low point. Your entry point could be at literally the high of this candle, and you might be like, that's insane. It's not, because look at the risk to reward. This is a good trade. You're gonna see on Instagram a lot of people say you need super high risk reward trades like 5 to 1s, 8 to 1s, 10 to 1s. You know, that's not necessarily realistic, especially as a day trader when you're trading momentum and identifying structure breaks and looking for good entry points. You know, you're not always going to be able to catch the lows and stuff, and that's fine, but you can still take solid trades and make money consistently by using these concepts. And as you can see, you could have taken this trade and targeted this first level. However, if you understood structure and stuff and you're like, okay, you know, this might break, I'm going to hold on to this, adjust my risk, make it break even, take partial, whatever the situation is, and ended up catching this whole move or something, you know? And that's highly realistic. That's why you can trade multiple positions or scale in. You know, once you took this trade and got out, possibly, like, okay, is the market going to make a higher low? Are we going to come back to this point? You know, that's all, it all goes hand in hand. So you're using the same exact things, time frame correlation. Okay, it made a higher low here. We got a bullish candle. It looks like it's going to break, so I'm going to take the risk once again. Make a tight stop loss below the slow point, because if it were, in theory, if it broke, then it's going to come back down and attempt some other level before trying to attempt to go bullish again. And so you could entered, and essentially one could entered here basically if you didn't get the good entry, and boom, impulse move. That's how it is. You know, I know it may seem really simple because, you know, the data's here and stuff, but this is how it is. This is all facts. This is all purely back tested. Okay, so last example is going to be from bullish to bearish, which is going to be down here. Okay, as you can see here, on the left side is the 4-hour time frame, and on the right side is the daily, like how we have been doing. And I'm going to just throw some arrows on here. As you can see, this is bullish, right? Higher highs, higher lows, higher high, higher low, higher high, until something switched, went from bullish to bearish, going from higher highs to higher lows to lower highs and lower lows into a downtrend, right? So how does one understand what happened here? Well, it's actually very clear. You can see on the higher time frame, support and structure typically go hand in hand, and it's the major key levels that are important, which is just major key levels and structure line up with each other. So basically, where this blue line is structure. If this point breaks, it's switching from bearish to bullish, at least for that point in time, until it hits a higher time frame level somewhere, which it did down here. But once this level broke, that's what initiated this bearish move, because it's a higher time frame point in structure. And if the higher time frame structures break, it initiates a bigger breakout move to that direction that the market is pushing in. So how could you have taken advantage of this? Well, one, you can understand that, okay, like I said, you don't need to be catching the tops all the time. It's not going to happen. You can still get in at a great price with little to no drawdown and still catch these breakout moves and break of structures, and, you know, these support and resistance level breaks, yada yada yada. You know, it's all the same stuff. Just you might not win every single time because you can't. It's a game of probabilities. So here we are. We're looking at this right here, this area. So you can see that there is bearish structure on the lower time frame here on this 2-hour time frame. You can see lower highs and lower lows very clearly. You can see that the level of resistance was formed here. It was previous support, now resistance. And you can see this major point of structure that I have drawn here. Once this level broke, it initiated this breakout. So how would you have caught this? You could have literally just done this right here. Stop loss right above the previous high, targeting these lows down here, which is like this wick based off the left side, because you're targeting support and resistance areas as well as structure for your take profits. You could also use Fibonacci extensions. However, I find more consistency using my support and resistance levels and key levels for take profits. So you could have this marked up in anticipation of, okay, the market's most likely to test this area, or shoot a little past, but this is where you're taking profit. So what happened? It literally just broke and straight down. I know it might seem pretty easy, but literally you can catch these moves every single day if you time them right and know what's going on. Like this happened right at London Open, you know. And if you're trading during session, like I've been saying, London session, New York session, catching a higher time frame move like this is very, very possible. That's all I have for this time frame correlation video, guys. I hope you guys learned a ton. I hope some light bulbs went off, and I hope this really helps in your guys' trading overall, you know. Hope you guys have a great trading week, and don't forget to like, subscribe, and follow on the Instagram. Peace.